So behind me is the investment portfolio for Berkshire Hathaway, run primarily by CEO Warren Buffett. Now, it's not too often that Buffett makes changes to his stock investment portfolio, so when he does, there's usually a fair amount of media attention. In this video, we'll walk through Buffett's over $350 billion portfolio, how he manages it, what stock trades he made during this quarter, and hopefully this will all give you a better perspective of the strategy that Buffett uses to manage Berkshire Hathaway's assets. Before we begin, I'd like to play an interview clip of Buffett from 1985, which can help provide some perspective on why we don't see very many portfolio changes with Berkshire. Here's the clip.
In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
So from that clip, I hope you can understand a bit more about Buffett's philosophy on waiting for the right investment pitch. For instance, if you look at the period in which each stock first made it into the portfolio, many of these stocks he's been holding for years, and several of them for even decades. Because Buffett doesn't like to trade in and out of positions, he's looking for long-term companies that he can buy and hold and let that growth compound for him over time. So let's now take a look at some of the largest positions in Buffett's portfolio if you're not familiar with them, and then we'll take a look at what has changed since the last filing. By far the largest position in Berkshire Hathaway's portfolio is Apple, which at filing represented 30% of the stock positions within the portfolio. As of February 14, 2020, that position was worth roughly $80 billion, or about 5.4% of Apple. Buffett over the years has also been a very large investor in financials, in particular banks. Buffett's positions in Bank of America, Wells Fargo, JP Morgan Chase, and US Bancorp represent over 25% of the stock portfolio's value. When we're looking at the top 9 positions, 3 of them have been long-term buy and holds for Buffett, with the Coca-Cola Company, American Express, and Moody's Corporation. Unfortunately, this data set only goes back to 2001, but he's been holding these positions for much longer than that. All 3 of these he's held for decades, and I think it's very unlikely to see him sell. And also within the top 9 of his portfolio is the Kraft Heinz Company, which is arguably probably the worst investment Buffett has made in recent times. The equity value of Kraft Heinz is down roughly 2/3 since Buffett made his initial investment in 2015. It should be noted that his preceding investment in Heinz Company was successful, but it was the merger with Kraft that really ended up being value destructive for shareholders. So when we look at the top 9 companies that we just identified, that made up at the time of filing roughly 81% of the stock portfolio value. The other 41 stocks in the portfolio represented the remaining 19 to 20% of the value in the stock portfolio. Graphically speaking, here's how the portfolio looks distributed on a pie chart where you can see the relative values. As you can see, Apple makes up the large majority, followed by Bank of America and Coca-Cola, and those 3 alone make up 50% of the portfolio. So while Buffett is diversified across 50 positions, his portfolio is still relatively concentrated, with 50% of the portfolio value within 3 stocks and 80% within the top 9. Now, one thing to keep in mind is that those portfolio positions are just the publicly traded stock positions in Berkshire Hathaway. Berkshire Hathaway also has many wholly owned private subsidiaries, which are private companies that Buffett owns entirely. In addition to the stock portfolio as well as privately owned businesses, Buffett holds a large and increasing cash pile. At the end of third quarter 2019, Buffett was holding roughly $128 billion in cash. Now, he stated that he always wants to hold at least $20 billion in cash as a reserve against potential insurance claims. However, if we back out that $20 billion held for insurance reserves, as well as $4 billion held in railroad and utility companies that Berkshire owns, then what's left is roughly $104 billion of investable cash that Buffett would like to deploy into more companies at the right price. As of mid-February 2020, the portfolio value of the stock positions were worth roughly $251 billion, and adding in that $104 billion of investable cash, the total investable portfolio is a whopping $355 billion. Some other insights we can get from this distribution is that Buffett, out of his total investable portfolio, is about 71% invested in stocks and 29 or about 30% invested in cash. Should we see a more serious market correction or even an economic slowdown, I seriously suspect Buffett will be wanting to deploy a majority of this cash during that time when valuations on many quality companies are trading much lower than they would today. Now, speaking of deploying capital, there have been some changes to the investment portfolio of Berkshire Hathaway. Some of the most notable changes are rather significant selling in a couple positions, two of them being Wells Fargo Company and Goldman Sachs. Now, it's not too often that Buffett sells off his positions. Usually when he buys, he likes to hold for a long time. So when he sells, usually there's a reason. This is partially speculation, but Buffett might be selling off a portion of his position in Wells Fargo in response due to the large fraud scandal that the company had encountered several years back. This was one of the largest abuses of fraud and breakdown in corporate governance in the history of the largest commercial banks. Buffett also tries to maintain a relatively clean public image, which is one of the reasons he's publicly stated he won't invest in tobacco companies. Perhaps given Wells Fargo's recent scandal, he's trying to send a message by selling a position in this stock. I don't know this, but this would be my best guess. There also were a few positions, including the largest Apple, that were trimmed by 2% or less. And in this quarter, there were 3 new positions opened in stocks that hadn't been in the portfolio before. Now, many people, when they think of Berkshire Hathaway's portfolio, they automatically assume it's Warren Buffett making and driving all of these investment decisions. But what some people might not know is that Buffett also has 2 independent investment managers, Todd Combs and Ted Weschler, who together independently manage roughly about $13 billion, or about 5% of the total stock portfolio. I want to play for you a quick clip of Buffett describing Todd and Ted's investment performance, as well as how they manage their portfolios. Here's a quick clip.
Let's get to another question from the audience. This comes from Brian Chan. He asks, how are Ted and Todd's performance since they joined about 8 years ago? Ted Weschler and Todd Combs, have they performed better than index? Charlie said recently that most money managers did not add any value compared to an index.
Yeah, the first few years, each of them, they came at a slightly different time, maybe a year to a year and a half or something different times. They got well ahead of the index and they got paid compensation. Now they got it paid so it came in thirds so that it could be clawed back 2/3 of it if they missed the second year and so on. Overall, they are a tiny bit behind the S&P each by just almost the same margin over the same time.
Over the entire period.
Over the entire period. And the entire period is a little different for both of them. They now manage about $13 billion each. They've done better than I have. So
well, that's a good measuring stick.
Yeah, so, no, it isn't the measuring stick, but I mention it because if I don't, somebody else will.
So given that Buffett has over $100 billion that he wants to deploy, he's going to be looking for larger deals, $5 billion, $10 billion, maybe even larger if possible, so that he can deploy a larger amount of his capital in a single deal. In my view, it's unlikely that Buffett's going to be the one making deals or purchases that are in the $500 million or less range, because that would represent less than 1% of Buffett's investable cash, and he's really looking to deploy more of that if possible. That's why when I see new positions in Kroger, Biogen, and interestingly enough, the Vanguard S&P 500, I'm more inclined to believe than not that it's Todd and Ted making these investment decisions and stock purchases. To give an example of a deal more of Buffett's size, Apollo Global offered $5 billion last year for tech data, and it was confirmed later on that Berkshire Hathaway was a secondary bidder for tech data. Now, Buffett does not get into bidding wars, which is why they told tech data it wouldn't be upping their bid, but this does seem like a more typical deal for Buffett. So when we're looking at the size of these investments, $550 million for Kroger, about $200 million for Biogen, and $12 million for the S&P 500 index, I'm fairly confident it's Todd and Ted driving these investment decisions. I'm not an expert by any means on biotech, so I won't be providing a lot of commentary here, But it's interestingly enough that Kroger is actually the largest individual stock position in my portfolio currently, so I will be diving into this investment here. Before we do that, I want to provide just a few notes on the S&P 500. It might be strange that Berkshire Hathaway or Todd and Ted, as investment managers who are trying to beat the S&P 500, end up just simply investing in the S&P 500. One potential explanation for this is that this holding is used sort of as a benchmark. For instance, in my own individual investment portfolio, the majority of my investments are within individual stocks, but I do hold a position within the exact same fund, VOO, the Vanguard S&P 500 ETF. And the reason I do that is I sort of use that as a benchmark to sort of gauge where my stock performance is relative to the S&P 500. And while I don't really look at this in the short term, over the long term, I hope this does, at least over a complete market cycle, help get a better sense of my relative performance of my investing strategies and decisions. Now, while $13 million is a large sum for most of us, in the context of Berkshire Hathaway's portfolio, it is a very small amount, which leads me to believe that this may be used as some kind of tracking index. Anyway, now I want to focus on Kroger, which is the largest new position in the portfolio. Now, I've mentioned that Kroger was the largest position at this time in my individual stock portfolio, and this is the stock price performance over the last year. Now, in the summer of 2019, Kroger was significantly undervalued in my mind, trading at the low 20s. Now, Berkshire's most recent 13F filing was for the period from September 30th, 2019, all the way through December 31st of 2019. So it was at some time during this period that Kroger was added to Berkshire's portfolio and at some level of price between these ranges. I also own Berkshire Hathaway stock within my individual portfolio, so for the benefit of other fellow Berkshire Hathaway shareholders, I'm hoping that Todd or Ted were able to purchase down here below $25 instead of the higher prices following Kroger's Investor Day. Now, my first position in Kroger was actually initiated a little while back, and that was after Amazon had bought Whole Foods, which really beat down most of the grocery store stocks, and Kroger was no exception. Since then, at a price of roughly $20 per share, the stock is up over 40%. Now, to get a better understanding of the potential future returns for Kroger and new Kroger shareholders like Berkshire Hathaway, we can take a look at this discounted earnings model that I put together for Kroger. If you're interested in using and downloading the same model, you can check that out in the link in the description below, where you'll have access to all of my financial models. So in this case for Kroger, we're doing a very simple 5-year model, and I'm assuming that earnings over the next year will grow roughly 7%, and then starting in the second year after that, for the next 4 years, we'll have earnings growing at 5% per year after that. With a starting annual earnings per share of $2.11, I'll also assume that Kroger is able on average to buy back about 1% of its shares outstanding per year. This means over the entire 5-year period, we're expecting about a 6.3% increase in earnings per share on an annualized rate. In this case, Kroger also pays out a dividend of 64 cents per year, or about a current yield of 2.2%, and a payout ratio of 30%, meaning that only about 30% of its earnings are paid out in the form of dividends. This is relatively low, so we can assume that this dividend payout ratio will change and increase over time so that Kroger's paying out more of its earnings in dividends. In this case, 5% might be a little aggressive, so I'm actually going to change this to 2%, which is a bit more conservative. The final two assumptions are very important for determining a rough intrinsic value estimation for the stock. I'm actually going to start with the second, which is the expected price to earnings ratio in 5 years. Currently, the price to earnings ratio is roughly 14.1, but to be conservative, I'm going to assume that the price to earnings ratio in 5 years is actually going to be lower than it is today at around 13. When the stock's been undervalued, the price to earnings ratio has traded in the past as low as 10, but I think 13 represents a more fair price for the stock. The final assumption we'll be using is the required rate of return or discount rate that we'll be using to discount the value of the stock when we sell it in 5 years, as well as the value of those reinvested dividends. If you're selecting 8% required rate of return here, the model will calculate the price of the stock you need to pay today in order for you to achieve an 8% rate of return, assuming all of the assumptions in this model hold true. In this case, based on the model and a fair valuation at an 8% required rate of return, the required price we need to buy Kroger at is $28.81. This return amount is modeled here with a starting principal of $10,000 and shows what proportion of your growth comes from earnings growth over time, as well as reinvested dividends, and potential change in valuation, which could add or take away from the total value in the stock. Now, using the same model and assuming that Berkshire added Kroger at $25 per share, we can estimate what the expected future return is at $25 by adjusting our required rate of return here. For instance, changing the discount rate to 10% gets us a fair valuation price of $26.40, which is higher than $25, so we can continue increasing the discount rate until we get this fair value at $25. In this case, it looks like that if you bought Kroger at $25 per share, which I'm hoping Berkshire Hathaway did, then you could expect roughly an 11.25 annualized percent rate of return for the next 5 years. In this case, the return would come from three components: the earnings growth over time, the value of those reinvested dividends, as well as valuation increase or multiple expansion over time, as the price to earnings ratio would gradually increase from about 12 when it was purchased at $25 per share to roughly 13, which was our modeled assumption. Now, there are still some uncertainties with investing with Kroger, as it is a very competitive space within the grocery industry. Currently, Kroger is the number 2 grocer behind Walmart as the number 1. But there are many other competitors, including Aldi and Amazon and Whole Foods, which will likely continue to make this a very competitive industry. That being said, in this market where valuations on most stocks are quite high, Kroger represents not only a value stock, but also a defensive stock as well. During a recession or any economic downturn, people are still going to need to eat. And in fact, if they do eat, they're more likely to eat in, purchasing food potentially at one of Kroger's grocery stores, than eating out where it's a more expensive option. In my view, buying a quality defensive stock at a fair price makes for an attractive investment thesis. At least it did for me when I bought Kroger in 2017. And now in 2020 and 2019, seeing Berkshire Hathaway add it to their portfolio is a vote of confidence. So again, if you're interested in this kind of tool and analysis, you can check out the link in the description below, but we'll go back again for some final commentary on Buffett's portfolio. So usually when doing these portfolio reviews, I'll do a quick comparison of the performance of the portfolio versus that of the S&P 500 and my own individual stock investments. Now, this is a very short-term period of less than 1.5 months, so it really isn't worth looking into that much, and it will fluctuate a lot over time. But when looking at Buffett's portfolio, it's no surprise that the majority of the performance will be driven by those largest positions. In this case, the majority of the gain from the portfolio is coming from his position in Apple. Over this short period in time, the portfolio is up about 3.8% compared to 4.9% for the S&P 500, and my portfolio at 5.3%. Again, these will fluctuate, so while this have been a couple good quarters for me, I do expect I'll be down some quarters as well. So in addition to general comments, I can provide some comments myself as a Berkshire Hathaway shareholder on what I would like to see with the portfolio of Berkshire Hathaway over time. Right now, Berkshire Hathaway still has that very large cash position at over $100 billion of investable cash. And right now, that really isn't generating much return for us shareholders. Now, this is sort of a double-edged sword. On one end, you would like to get this invested so it can start earning rates of return higher than just the 1 or 2% that are being earned on treasury bills at the moment. On the flip side though, if you're able to be patient and wait for a better opportunity, you can achieve even higher rates of return. For instance, instead of investing today at let's say 6 or 7%, you might be able to find an opportunity a year or two down the road at 10 or 11%. However, that being said, we've been waiting quite a while for an investment, and while there have been some potential investments like Tech Data and apparently another large elephant, so to speak, that got away in the fourth quarter of 2018, we've been seeing a relatively constant cash drag on the portfolio over this time. Additionally, since 2009 and the financial crisis, Buffett's portfolio, with the exception of his investment in Apple in 2016, has largely missed much of the tech growth that has occurred over this last decade. Simply put, Buffett would have been better off buying an index fund instead of selecting the individual stocks he did over the last 10 years. Now, given that valuations in the market are much higher today in 2020 than they were in 2010, I don't think now is the time to start initiating that strategy. That being said, one other option Buffett has in terms of his portfolio to deploy some of this cash at attractive returns is to buy back their own stock. Buffett has done this in small amounts in the past when he believes that the stock is trading below its intrinsic value, conservatively estimated. Historically, this level has been roughly around 1.2 times book value for the stock, and the stock hasn't dropped below that value and only got really close in the beginning of 2016. In hindsight, buying back shares would have been a much better use of capital than holding cash during this period in time. Overall, I hope this video helped give you a better sense of Warren Buffett's portfolio and his investment style. If you enjoy portfolio reviews like this, leave this video a thumbs up and let me know in the comments below who you'd like to see next. And if you're new here and haven't yet subscribed, take a second to do so to gain access to more investment content like this. Until next time, my name's Michael, thank you so much for watching, and I will see you in the next video.